So friends, a warm welcome to this new chapter, Study of Derivatives. We'll be covering the syllabus pertaining to CFA Level 1. We'll be starting with definition of derivatives, types of derivatives, trying to define the kinds of markets that are there, the market structures, and also the implications of different kinds of derivatives that we have in the markets. Right? So let's get on with it. First of all, before we start the study of derivatives in any meaningful terms, let us understand what is the meaning of a derivative. Let's say you and your friend are watching a football match between A and B. Now, in the middle of the match, you and your friends strike a deal. The deal is like this. You both put $100 on the table, right? And the deal is like this. If A wins, your friend takes the entire $200 that is on the table. And if B wins, you take the entire $200. Right? So, when we are talking about derivatives, this is basically a very simple kind of derivative, my friends. Because how a derivative is defined, let me tell you. Derivative is basically a financial instrument which derives its performance based on the performance of an underlying. Now, here what is the underlying? Here the underlying is the performance of the teams or whichever team wins. So, underlying here is winning, right? Underlying here is winning. Either team A wins or team B wins. Whichever team wins, the person on that side basically gets the entire amount. Now, whatever contract you two struck in this format, this is basically a derivative contract that we put 100 and 100, and based on the victory, the entire amount is given to the person who is on the side of the victorious team, right? This is a simple derivative, friends. Financial instrument which is deriving its performance based on an underlying, which is victory of either of the teams, A or B. Now, we will proceed a little further and take a few finance-oriented examples this time. Let's say a man named John has 1 kg of gold and he wants to get the best price by selling it. Now, let's say currently the price is $2,400. Currently means, let's say, T is equal to 0. Now, John thinks that in 3 months, T is equal to 3 months, the price of the gold will come down. It will come down. He is apprehensive. So, he wants to get the best price by striking a derivative contract. So he says, I am creating a contract where 3 months down the line, anybody can buy from me gold at $2,400 per ounce. This is per ounce, right? So this is the contract, friends. This is saying that at T is equal to 3 months, John will be delivering gold at $2,400 per ounce to any buyer. Buyer of what? Buyer of this contract. Right? So incidentally, this kind of a contract is called a forward contract. Okay? We'll know much more about forward contract and other kinds of derivatives in a very short while. But right now I'm just taking an example that this is how a deal is struck. This is basically a futuristic value that we are putting on some underlying, and based on that we are creating a financial instrument or a contract and we are buying and selling it. That is what a derivative is basically. Now let's say there is a stock XYZ, let's say. The price of it is right now, let's say, $20 per share, right? Now, an investor named Prakash, let's say, has a view on the price of this stock. Prakash thinks that in 3 months, the price of this stock will be $35. Now, based on this speculation, Prakash strikes a contract. He says, right now I am willing to sell a contract where I commit that I'll be buying the stock at $25 per share when 3 months are over. That is at T is equal to 3 months. And this contract I am willing to strike right now. Okay. Now let's say to this contract there is a buyer. A buyer who thinks that this stock will not go up till 25. In fact, he thinks that when 3 months are over, the stock price will be, let's say, $21. Right? There is a buyer who thinks like this, buyer of this contract, derivative contract. Now, he is thinking that at the end of 3 months, he is going to make a profit of 25 minus 21, that is $4 per share by getting into this contract. So both are basically getting into a contract because they have different views on the performance of the underlying. This contract is basically an overlay on the underlying performance of the stock price. This basically, the value of this derivative is derived by the performance of the stock, right? The stock price. So this is a derivative. Now we will formally define what is a derivative. So a derivative is a financial instrument that derives its performance based on the performance of an underlying. Now that underlying can be a stock, it can be a bond, it can be a commodity like gold, it can be something intangible like weather. So that's how derivatives can be designed. Forward commitments and contingent claims. What do we mean by these terms? These are basically the two primary categories of derivatives. Forward commitment is the first kind of derivative that we'll talk about. So what are forward commitments? Forward commitments are derivatives which once you get into the contract, you cannot back out. You do not have an option of not executing the contract when the time has arrived. Let's say you have got into a forward commitment for 3 months, that is T is equal to 0 right now, and the commitment execution times comes at 3 months. Now at 3 months, whether you are making a loss out of this contract or making a profit out of this contract, you have to execute the contract. Let's say John had this gold, right? John thought that the price will go down from $2,400 to lower levels, let's say 2200 or 2100, whatever, right? But at the end of 3 months, the price was $2,700. But he has entered into this contract that he is going to sell it at $2,400 at the end of 3 months. Now the person who has bought this contract from John, John has to execute the contract and fulfill the agreement towards that person, right? So John, by executing this contract, is effectively making a loss of $300, right? John is making a loss because he could have sold it in the market at $2,700, but instead he has to sell the gold to the buyer of the contract at $2,400. Now the buyer effectively is making the profit. The loss of the seller in this case is the profit of the buyer of this contract. So in the market he would have had to buy at 2,700 per ounce. Here he is buying it at 2,400, right? This is what we call a forward commitment. The commitment word is very important here because once you enter into the contract, you have to fulfill the commitment or else you are labeled a defaulter, right? So here it is a commitment. There is no choice. You cannot not get into the contract when the time has come just because you are making a loss or something like that or some other reason has come. You have to fulfill the commitment or else you are called a defaulter. Now, this is the example of a forward commitment. So forward commitments are derivatives which force the execution on the involved parties at maturity. So it is forcing the execution to both the parties. So in the case of John here, whoever has bought the contract, he or she cannot get out of the contract just because the price of the gold has actually gone down. Let's say the price went down to 2,100. In this case, John is making a profit, right? Plus 300. and the buyer is making a loss of minus 300. But just because minus 300 the loss is coming, the buyer cannot back out from this contract. He or she has to fulfill the contract, or else he or she is labeled as a defaulter. It is both sides, it is enforced. There is no backing out once you get into a forward commitment. An example of a forward commitment is a futures contract, is a forward contract. Likewise. Now we'll get into the second category of derivatives, which is called a contingent claim. Now, contingent claims is the second category of derivatives that we are going to discuss here, friends. So, in the previous one, we found out that once the contract has been entered into, there is no getting out of it, right? Now, contingent claims are those contracts of derivatives which gives the buyer an option to back out if the condition is not suitable for him or her, or based on his or her choice, right? So, the example, let us take an example of this. Let's say Prakash is of the view that the stock, which is $20 right now, is going to be $35 when 3 months are over, right? T is equal to 3 months. Now he creates a contract. He says that I think this is the case, and I am willing to buy the stock. I am willing to sell a contract which says that I am willing to buy the stock at $25 at T is equal to 3 months. Now he is the seller of this contract, right? Seller of this contract. And the condition is you can back out of this contract at the end of 3 months, but for that right now you have to pay me. Prakash is saying that this is the contract, I am selling this contract. The buyer can buy this contract, but at T is equal to 3 months, he or she can back out of this contract if right now he or she pays me a security deposit of $5 per share. Right, this is the condition he has. That if you want to take the option of backing out when condition is not suitable for you, for any other reason, you want to back out at T is equal to 3, you have that option, but for that you have to pay right now an amount of $5 per share to me per contract or per stock. So this kind of a derivative contract is called a contingent claim, and what the example that we took right now is basically a form of an option. This is what we call a stock option. So Prakash has created this stock option which is selling at a margin of, we say it's a margin of $5 per share. Now if the buyer pays this amount to Prakash, he or she gets into the contract, but has the option to back out for any reason at the end of 3 months or whatever time the maturity happens, or whatever time the buyer wishes to execute the contract, depending on what kind of option it is, right? So the backing out option is here, but the cost for it is $5 per share. So this is a stock option, typical stock option, and our stock option is basically a typical example of contingent claim. So friends, these derivative contracts that buyers and sellers get into, they can do it in markets, and the markets of derivatives are of two kinds. One is the organized exchanges based market, another is the OTC or the over the counter market. So let's discuss what are the similarities and what are the differences between these different kinds of derivative markets. So first we'll discuss about the organized markets or the organized exchanges. So what are these? Let's say you want to buy an option or a contingent claim on a stock XYZ. Okay, the stock price is 35. You think that it will come down to 25, and you want to short the stock with the help of a derivative. Now, the derivative contract, if you go into the organized exchange, will have a fixed contract size. Let's say the contract size for a option which bets on price reduction rather than price gain, this contract size is $10,000, right? The contract size is $10,000, and you have to pay a margin of, let's say, 5% or 10% on the contract size to enter into this contract. So you will have to pay how much? If it is 5%, you will have to pay 5% of 10,000, which is $500 to enter into the contract. So the number one property is contracts are fixed. Contracts are fixed. Not only in terms of contract size, it may so happen that the maturity is also fixed. So you want to enter a contract for 1 month, but in the exchange only 3-month ones are available. So this is a 3-month contract, let's say. So you hardly can change it, right? Considering this is not an option which you can sell at any time, you can hardly change it. You cannot change the contract specifications that are given in an exchange, right? So contracts are fixed. Number 2 is the buyer and seller both put their bets on the exchange. So it's like you and your friend put the money on the table, right? In the football game contract, you and your friend put the money on the table. And here, let's say you gave it to a person who is going to ensure that there is no breach of contract at the end of it. So you and your friend, let's say, gave it to a third friend who is going to ensure that none of you play foul when the game ends. So this is what the exchange is going to do. The buyer and the seller both speculate or both get into the option contract under the supervision of the exchange, right? Under the supervision of the exchange, and the exchange provides credit guarantee. Now, how does exchange provide credit guarantee? One of the things is it does it through this margin, the margin that we spoke about, 5% or 10%. This margin they take from everyone who get into the contracts, and it is based on certain numbers. In such, it is so efficient that in the last 100 years default has not happened. At least when I talk about USA, in the last 100 years default has not yet happened. We'll talk about this in more details when we get into the types of derivatives and how they work. Okay, so this is exchange supervision, exchange credit guarantee based on margin specifically. The third is transparency. Transparency means the exchange authorities, the authorities basically are able to see who has got into what contract, who has entered which contract, they can easily track. So transparency also means loss of privacy. Okay, these are the main features. Contracts are fixed. There is exchange supervision, which implies credit guarantee, and there is transparency. These are the three main features of the organized market. Now we will talk about the OTC or the over-the-counter markets. Now, example of derivative contracts which are traded in organized exchanges are futures contracts and option contracts. Now we will talk about the second category of markets, which is the OTC market or the over-the-counter market. Now we will talk about the OTC or the over-the-counter markets. So these markets are basically informal markets where willing participants trade among themselves any kind of derivatives that can be legally created, and they do it through the help of principals who are basically banks who act as dealers of these OTC markets. So let me repeat once again. Generally, these are major banks who are acting as dealers, and these dealers get into various kinds of derivative contracts which come from corporations or other banks, and they do it in such a way that the overall derivative scenario is balanced. That is, let's say somebody has got into a derivative of hedging their risk against the fall of euro. Now the dealers get into such contracts also where this kind of a hedging, that is hedging against fall of euro, is balanced with other contracts which hedge against rise of euro. So the overall balance is maintained in this way. Now the opposing contracts are generally not in exact terms, let's say somebody is hedging $100 million of euro in this one, that is, they are hedging 100 millions against the falling of euro. The opposing derivatives may not be 100 exactly, they may be 10 contracts of 10 million each, or 2 contracts of 50 million each, or maybe 120 million of contracts like this. So, but they are not exact matches, but in time and space, the banks and dealers, through their model expertise and their volume of trades, they are able to balance it overall in a reasonable sense. Now these banks who are acting as dealers are generally members of ISDA. ISDA is basically called the International Swaps and Derivatives Association. They are members of these. Now the features of the OTC markets, let's discuss that. OTC markets, first of all, are informal. This means that these banks or dealers, these banks who are acting as dealers, are not obliged to do so. They are not obliged. So today they are trading in derivatives, tomorrow if they don't want, they don't trade. Right? That does not mean they back out of entered contracts, but that solely means that whenever they want, they can contract or expand the vertical as per their will. Number 2 is there is less regulation. Less regulation also means more counterparty risk. In case of exchange traded contracts, the organized exchanges were basically giving the credit guarantee. In case of OTC markets, such guarantees do not exist. It is the party itself based on whom you take the contract. Number 3, there is more flexibility. You can create different kinds of contracts, right? The only thing is both the parties have to agree to the contract, then only they can be created and executed. Number 4 is less transparency and more privacy. One caveat one must enter here. After the 2008 financial crisis, the regulations have become tighter and there is more striving towards increased transparency. But nevertheless, compared to the exchange traded markets, there are a lot of exemptions which these OTC markets enjoy. Now, having discussed the different kinds of derivative markets, we would now like to go into the discussion of the different types of derivatives that are traded in the markets. Let's get on with it. The primary types of derivative contracts that we discussed about were forward commitments and contingent claims, right? Now the 3 major kinds of forward commitments that we will discuss here are forward contracts, future contracts, and swaps. So first, let us discuss what are forward contracts. Let us take an example, friends. Let's say a person named ABC has 1 kg of silver. The price of this is, let's say, $1,000 for 1 kg, right? Now ABC feels that the price of silver has reached its peak, and in the future, let's say 3 months, the price of the silver is going to be down. Okay, so ABC creates a forward contract which says that ABC is willing to sell the silver at $1,000 3 months from now. So the forward contract says that 3 months from the initiation of the contract, ABC is going to sell the 1 kg of silver at $1,000 once the forward contract has been initiated. Okay, this is what we call a forward contract. Now this $1,000 can be symbolized as F0 T. T is basically the maturity time, which is 3 months. Initiation time is T is equal to 0. Maturity is generalized as T is equal to capital T, let's say. Therefore, the forward price, that is the price at which the contract will be fulfilled at the end of the maturity of the contract period, is denoted by F0T, let's say. Now at that time, let's say the market price of the silver is ST, that is at T is equal to T, or in this case, which is 3 months, right? Now, who makes a profit and who makes a loss? That is the question, right? So, let's say ABC has entered this contract with XYZ, right? XYZ has bought the contract from ABC. Now, in derivative parlance, ABC is the seller of the contract. That means he's the seller, means he's the short entity. He has shorted. And XYZ has bought the contract. He is the buyer. So he is the long entity with respect to the contract. Right? Now let's say at T is equal to T, which is 3 months in this case, the price of silver is $1,200 per kg. In this case, gain to the buyer is, this is case 1, let's say. Gain to the buyer, that is XYZ, is equal to 1200 minus 1000. This is equal to $200. Why? Because from the market, if he had to buy, he would have had to buy it at 1200. Now he bought it at 1000, so he made a gain of $200. And the loss to the seller, loss to ABC, is equal to minus $200. Because if he had sold in the market, he would have sold it at 1200. Now he has to sell it at 1000, because this is a forward commitment. He cannot back out. So he will take a loss of minus $200. So this is case 1, right? Now case 2. Let's say the price at T is equal to T is $900. $900 per kg. In this case, ABC has gained. A gain to the seller or the ABC is equal to 1000 minus 900, or $1,000. And loss to the buyer XYZ is equal to minus $100. Why? Because if the buyer had bought from the market, he or she could have bought it at $900, but now he has to buy it at $1,000 from ABC, because he has entered into a forward commitment contract, which is a forward contract is basically a forward commitment contract. You cannot back out from it, so he has to take a loss. He or she has to take a loss of minus $100. The case 3 is at T is equal to T, the price remains at $1,000 per kg. In that case, no loss, no gain. No loss, no gain for either ABC or XYZ. Now the generalized formula, you can draw a generalized formula for this. From these case studies, you can basically derive a generalized formula for this forward contracts. The value to the long side of a forward contract at maturity is given by Vt is equal to St minus F0t. St is the market price at maturity of the underlying, right? And F0t is the contract price at maturity of the same underlying. Now, the value to the short of the forward contract at maturity is given by minus Vt is equal to F0t minus St. So you can understand that if the market price is higher than the contract price, the person who is long the forward contract makes a gain, and the reverse happens to the short person. Similarly, when the market price is less than the contract price, the short side of the forward gains while the long sides makes a loss. So St greater than F0t means the long party gains. And F0t greater than Ft means the short party gains. So friends, now we are in a place to talk about the features of the forward contracts. So firstly, it's an OTC contract, over the counter contract. So which means it's going to be flexible. It's not standardized, neither the maturity nor the contract size. So it's more flexible. Third is, there is more privacy, which means less transparency. Fourth, and the biggest worry of it all is, there is counterparty risk. Counterparty risk. This means for any reason one of the parties, mostly it happens when there is a loss to be made by that party may not fulfill the commitment made through the contract. Okay. So these are the four main features of a forward contract. Now, based on these features, we can define a forward contract also. So, a forward contract is an over-the-counter financial instrument that binds two parties, a seller and a buyer, where the seller is committed to sell the underlying at the price decided at the contract initiation to the buyer at maturity, while the buyer also is committed to buy it at the pre-decided conditions at maturity. So both parties are bound by the contract. They have to fulfill the commitment. So this is what a forward contract stands for. Now, it is not always that cash is exchanged for the underlying to fulfill the contract. There are many ways of fulfilling a forward contract, which depends on the contract itself. So there can be non-deliverable forward contracts, NDFs, cash settled contracts, contracts for differences. So in all these cases, the underlying does not exchange hands. There is a cash transaction. Whoever is the gaining position may take the difference of the cash amounts of the market price and the contract price. That's how these contracts generally work, right? Now we will move to a second kind of forward commitment, which is more standardized and exchange based. So that is called the futures contract. Let's discuss that, friends. Now we will try to understand what is a futures contract through an example, friends. So as we know, futures contract is basically something that happens in an exchange, right? The exchange works as the clearinghouse and gives credit guarantee. So let's say there is a stock which is priced at $100. Now, based on this, a futures contract is created. A futures contract is created. This futures contract size is, let's say, $1,000. That means 10 stocks, right? Now there are two people who are trying to speculate over this stock. Okay, one thinks in 30 days the stock will move to 120, but he doesn't want to buy the stock directly. He wants to do it through the futures contract. Now another person is there who thinks in 30 days the stock price will be $70. $70 is his speculation and $120 is another person's speculation. They both want to get into this contract. Now, what will they do? The long person, the long entity buys this contract. So, in this side is the buyer. And the short entity sells this contract. Here is the seller. Now, neither the buyer nor the seller need to exchange $1,000 to enter into this contract. They just need to pay something called the initial margin. The initial margin. Let's say in this case it is $100, right? So they both put in their accounts $100 each, $100 each they have put to enter into this contract. One is on the sell side, one is on the buy side. Now, they both think in 30 days the end result will happen, right? 120 will happen in 30 days, the buyer thinks so, and $70 will happen in 30 days, the seller thinks so. So this contract also, let's say, expires in 30 days, and that is why they have entered this contract. Okay, right now the time is t is equal to 0. The maturity period t is equal to capital T is equal to 30 days. Okay, now a futures contract is, obviously this is happening through the exchange. There is no individual or person to person exchange happening here. It is happening through the exchange, right? Now this future contract through the exchange is marked to market at the end of each day. So let's say at the first day t is equal to 1, the stock price becomes 102. Okay, and for simplicity's sake, let us assume that the futures contract moves exactly in sync with the underlying. So the contract now is 1020. So what was $1,000 has become 1020. So the buyer is in the long side here. So he is in the profit. And how much he has profited? $20 at the end of the first day, right? Similarly, on the other hand, the seller is on the losing side and he has lost exactly $20. Okay, so this is how it is going at the end of the first day. Now let us say that at the end of the second day, the price of the stock from 102 moves to $108. The contract naturally has become 1080. And on the second day, the buyer gains another $60. And the seller loses another $60. So the seller is still now having a bad time. Now what is the amount left in their accounts at this point? The buyer has 100 plus 80, $180. Wow. And the seller has 100 minus 80, which is $20. This is also wow. Now there is a problem, friends. There is something called the maintenance margin. The maintenance margin is the minimum margin that an account needs to hold to stay in a futures contract. Now let's say in this case the maintenance margin was $60. Okay, it was $60. Now at the end of day 1, the buyer had $120 in his account, in his or her account, and the seller had $80. So the maintenance margin was not breached for either, right? It was above 60 for both. But in this case, we have a maintenance margin breach, and that has been breached on part of the seller. This is a breach here, right? So the seller now has to make amends. And how does the seller make amends? The seller has to put back that much amount into the account, which brings the balance back up to the initial margin. So the seller now has to add $80 more, so that his account balance is $100, which is equal to the initial margin. So once the maintenance margin is breached, it is not the maintenance margin that has to be reached. It is the initial margin that has to be reached. So this is just to have a buffer, right? This is just to have a buffer. Now the seller may choose that the seller does not want to stay in the contract anymore. In that case, whatever losses are there, the seller has to bear and get out of the contract and close it. If there are some extra losses, that also has to be fulfilled and paid by the seller to get out of this contract. Otherwise, if the seller wants to remain in this contract, the seller has to pay $80 at this stage. This is the requirement. So this phenomenon is called margin call. This phenomenon is called margin call. So this thing has done a lot of harm in the markets to many entities, not only individuals. It has the capability of wiping out entire enterprises. This has happened before. Those who have speculated beyond a certain point without hedging it, or those who have taken too much risk without by having certain amount of confidence in their decisions, they have been wiped out because of certain changes in the markets which went contrary to their speculations, and margin calls happened and their accounts have been wiped out. This has happened before. So this phenomenon is famously known as margin call. So we have understood three terms here: margin call, maintenance margin, and initial margin. Initial margin. So what is the initial margin, friends? Initial margin is the initial amount that the buyer and seller of a futures contract need to pay in order to enter into the same, or in order to enter into the contract. Then there is maintenance margin. Maintenance margin is what? It is the minimum amount of balance that an account needs to have for the account holder to remain in that kind of futures contract. Now, what is margin call? Margin call is when the balance in the account falls below the maintenance margin. There is a requirement that one has to fulfill or refill the account so that it reaches back to the initial margin, not the maintenance margin. It has to reach back to the initial margin. This phenomenon is called the margin call. So we have understood majorly what are the points in a futures contract. Now we'll understand a few more terms related to the futures contract, and then we will try to understand the features of a futures contract, and in the end define futures contract. Now in futures contract there is something called the price limits. This is basically, let's say a contract right now is at a certain price X. There is an upper band and a lower band put on both sides of it. It cannot trade beyond this, right? And it cannot trade beyond this also. So this is called basically the price limits. If the price hits the upper limit, say somebody wants to trade somewhere here, then it hits the limit here. This phenomenon is called limit up, and the trading stops. Similarly, if somebody wants to trade, say at some price like this, in this case the price hits the limit downwards. This is called limit down. And here also the trading stops. Now this stoppage of the trading is called locked limit. So again we have heard four new terms: price limits, limit up, limit down, and lock limits. To revise, there is a band within which a contract may trade. That band is basically called the price limits. Now if someone wants to trade at a value higher than the upper limit, then something called the limit up happens, as the upper limit is hit and the trade is stopped. And if somebody wants to trade at a price lower than the lower limit, then the price hits the lower limit in that case and limit down happens. A phenomenon called limit down happens, and again the trading stops. This phenomenon of the price hitting any of the limits and the trade stopping is called locked limit. Now, the price of the contract changing every day based on the performance of the underlying, this phenomenon is called marking to market. Now we have to understand what is the cumulative gain or the loss to the buyer or the seller at the end of the expiration if both hold on to the contract till expiration, right? So let's say at t is equal to 3, the price of the stock went to 90. Suddenly there is a sharp fall. Therefore, the contract went to $900, right? because we are assuming that the contract is exactly moving in sync with the performance of the underlying for simplicity's sake. In this case, the movement is 1080 to 90. Sorry, 1080 to 900. So the total movement is $180. Now, what happens to the buyer's account? He was plus 180. Now he is minus 180. Straight away he has become minus 180. So his balance is 0. Right? Now what happens to the seller? For the seller it's a plus 180. So he was let's say the seller was at $20, right? The seller was at $20 plus 180. This takes his account balance to plus $200. This is the situation of the seller after the third day. Now if you look at the entire phenomenon, what is happening? What is happening is basically the cumulative change is the total change. The total change is basically the cumulative change that happens across all the days of the contract, across the expiration. So let's say first day the change was plus 20 for the buyer, next day it was plus 60, next day it was minus 80, then it was plus 50, then it was plus 100. Summing all this up, whatever value comes up, that is basically the net gain or loss for the buyer. Same goes for the seller. The first day his loss was 20, second day his loss was 60, third day his profit was 180. Let's say then again the loss was minus 50, then again the loss was minus 10. Summing all this up till the time the expiration happens, let's assuming that both of them hold on till expiration, whatever happens till the end, that is their gain or loss. And this will come to basically, now the value at expiration, considering expiration happens at capital T, this is given by the difference between value at contract initiation, which is F0, and value at contract maturity or expiration, which is F capital T. The difference between this. If capital T or the value at contract maturity is more, so if T is greater than F0, this implies the buyer or the long gains. If the reverse happens, that is F0 is greater than Ft, this implies that the seller or the short gains. So this is all about the futures contract that we just discussed. Okay. Now we will have a look at the features of it. We have discussed a few alongside this example. Now we will look at the theoretical part. Now we'll look at the features from theoretical angle. So firstly, this is exchange traded. It is less flexible. It is more transparent. That is, privacy is less. And most importantly, there is credit guarantee provided by the clearing house. The credit guarantee is there. How does the clearing house guarantee credit and how has it not failed? So this is a point of direction. This is the point of contention, friends. So one way is it takes margins, right? It takes margins. And the second is it keeps price limits. So one thing is it takes margins as security deposits, right? Second thing is it has price limits. There are price bands of trading. So the exposure for any trade is limited within the band. These two factors help the credit or the clearing house keep the credit guarantee, and astonishingly they have been able to so far not fail in it. So therefore, from these phenomena or from these features, we will try to define what is a futures contract. A futures contract is an exchange-traded, standardized forward commitment with credit guarantee which binds a buyer and a seller of the contract to fulfill the mark-to-market conditions of the contract till expiration by maintaining the margin requirements, thereby bearing the cumulative gain or loss at expiration provided this stay till the expiration. So this can be a definition of a futures contract, friends. Now friends, before we move on to the next forward commitment, which is swaps, one question needs to be answered. So let us think about this question, friends. What is the exchange between the buyer and the seller at the initiation of a contract? We all have understood that at the end of the contract or on daily mark to markets, there is some exchange happening. But at the initiation, what is the exchange between the buyer and the seller? For a forward contract and also for a futures contract. The answer is the initial exchange. The initial exchange of the initial value is 0. There is no exchange. Both in case of a futures contract and in case of a forward contract. At t is equal to 0, the exchange or the value of the contract is 0. It is only after the performance of the underlying is deciphered at the end of the expiration or along the expiration, on the way to the expiration, that the value is decided. Even in case of a forward contract, the initial value or the initial exchange is 0. There is no initial exchange. So this is a very important aspect of both forward contract and futures contract. Now we will try to understand the third forward commitment or the third type of forward commitment, which is a swap. Now let's say you are an entity, you have taken a loan for 2 years, that is 2 years is the maturity period of the loan, and the payments are quarterly. So you have taken the loan at t is equal to 0 and there are quarterly payments, right? T is equal to 1, 2, 3, 4. This is the end of the first year. Then there is 5, 6, 7, 8. And there is end of the second year. Your loan completes at the end of the second year. That is when t is equal to 8. Right? Now you have taken loan here. T is equal to 0. Now this loan has a special characteristic. This loan is a floating rate loan. So if interest rates rise, your cost rises. If interest rates fall, your cost falls. Now you feel that in the coming 2 years, the economy, because it is facing very high inflation, the central bank might increase the rates. So which means your cost is, according to your speculation, your perception, it may rise. So you do not want to keep the risk of rising interest rates on your account. You want to pass it on. Now how do you pass it on? You can pass it on by exchanging the floating rates or the floating rate payments for fixed rate payments through a swap. Now how do you do that? Let's take an example. So let's say you have this loan, floating rate loan. Let's call it FL, and you have the payments, and you have, because it's a floating rate loan, you have variable payments. Let's say they are given by S1, S2, S3, S4, S5, S6, S7 and S8. These are your variable payments or floating payments. That is, they depend on the rise and fall of interest rates. Now, as we said, that you think that the interest rates are going to rise. This means that your payments you think are going to go up. So you do not want to keep that risk on your account. Now what you do is, you go to a swap dealer. You go to a swap dealer and you tell the swap dealer that you want to get into a swap which takes from you fixed payments and in return gives you back the floating payments. So you say, I will give you the fixed payments, something called FX, let's say. I'll give you this fixed rate FX, and in return you will give me the variable payments. Let's denote it by SI. It can be S1, S2, S3, S4, whatever. Now what happens is, your payment has become fixed, and in return you are getting the variable payments. So in each of these terms you are paying the swap dealer FX, and in return the swap dealer is paying you S1, S2, S3, S4, S5, like this. These payments are being paid by the swap dealer. Now what is the net value of this swap, friends? So the net value of this swap, let's say at maturity, given by capital T, here capital T is equal to 8, right? So here the value is sum of the variable payments minus sum of the fixed payments. This is the value to the person who has taken the loan, that is you, the person who has taken the loan. And the value to the dealer is exactly the reverse of it. Minus Vt is equal to sum of FX minus sum of the variable payments. This is the value to the swap dealer. So the swap dealer, what the entity does is, it fixes the FX, that is the fixed payment, based on its own perception of what is going to be the future interest rates. Whether it has a perception that it is going to rise or it is going to fall, it is going to give you a fixed rate which it feels is going to end up making the dealer have some net margin. That is the goal of the swap dealer. Now, if the speculation of the swap dealer for these interest rates for the next 8 periods or 8 quarters does not match with the actual numbers, then there are chances that the swap dealer will be in loss. And if it matches with the swap dealer speculations, then the fixed rate will be generally, most of the times it will be such that the swap dealer will be in profit. So if the swap dealer is in profit, that means the person who has entered the swap, that is you, will be in loss. And if the swap dealer is in loss, then you will be in profit. So that's how it happens. Let's say a company named XYZ Inc. has entered into a floating rate loan. Now the feature of this floating rate loan is, naturally, if the interest rates rise, the costs will rise, and if the interest rates fall, the cost will go down. Now let's say the loan has quarterly payments and its maturity is in 2 years. So there are 8 payments till maturity. So the loan has been taken, let's say, at t is equal to 0, and the payments are at t is equal to 1, 2, 3, 4, 5, 6, 7 and 8. So at t is equal to 8, the loan matures. That is, all the payments are paid. T is equal to 4 is the end of year 1 and t is equal to 8 is the end of year 2, which is the maturity period of the loan. Now because these are variable payments, this floating rate loan has variable payments. Let's say these payments are given by S1, S2, S3, S4 till S8. Now XYZ Inc. has a opinion about the future interest rates. It thinks that the interest rates are going to rise. Because the economy is under inflation, XYZ Inc. is of the opinion that the interest rates are going to rise, which means its costs have the risk of going up. Now it does not want to keep this risk with its own account. It wants to mitigate this risk. Now how can it do it? What the entity can do is, XYZ can go to a swap dealer. It can go to a swap dealer and get into a swap which pays the entity the floating rates in exchange for a fixed amount on a quarterly basis. So now what happens is this S1, S2, S3, these payments are being paid by the swap dealer in exchange of a fixed amount being paid by the XYZ entity to the swap dealer. So now the XYZ entity has payments obligation of FX every quarter. This is a fixed amount, let's say. So every quarter, this amount XYZ is paying. And it is paying to whom? It is paying to the swap dealer. And in exchange, these floating rates S1 till S8, they are being paid by the swap dealer to XYZ. So these variable payments are being paid by the swap dealer to XYZ. Okay. So this is a fine setting. So friends, at maturity, what is the value of this swap? So at maturity, the value of the swap to XYZ is equal to sum of the payments it is receiving, that is sum of all the variable payments, minus sum of the payments it is paying, sum of all the FXs, right? And the contrary goes for the swap dealer. So value to the swap dealer is equal to sum of the payments it is receiving, that is FX, sum of all the FX, minus sum of the payments it is paying to sum of the all variable payments. So this is the value at maturity of this swap. How the cash flow looks like? Basically what is happening is there are three entities. So there is the lender to XYZ, there is XYZ, and there is the swap dealer. Let's call it SD. Now XYZ is paying FX at each period to the swap dealer. The swap dealer is paying the variable payment SI. This variable payment XYZ is paying back to the lender. So the lender gets what it wants, XYZ gets what it wants, and the swap dealer also gets what it wants. Swap dealer generally fixes a rate of FX in this kind of a swap based on its own assessment of the markets, the interest rates, etc., etc. It has its own expertise to fix the rates. Now, if its speculation is wrong, then it can be in the losing side, and if its speculation is right, then it will get a net margin after the swap deal is completed. So that's how a swap works. Now, what are the features of a swap? It is an OTC contract. So in that sense, it is more like a forward contract rather than a futures contract. So obviously, if it's an OTC contract, it will have more flexibility. It will have more privacy, and it will have counterparty risk. This will be there. Additional features of swap, it has, rather than having a single payment, it has a series of payments. Now what can the payments be? It can be fixed for a floating rate or another fixed rate. It can be variable series of payments based on one underlying against a variable series of payments against another underlying, or a fixed series of payments against another underlying. So this is how it works. A variable series against one underlying against a variable or a fixed series against another underlying. Now we are in a position where we are able to define the swaps. Let's try to define it. So a swap is an over-the-counter derivative contract which binds the buyer and the seller of the contract to exchange a series of payments between them, where one end is variable following an underlying asset or rate, and the other end, that is other end of the payment, is either variable or fixed following another different underlying asset or rate. I'll repeat once again. A swap is an over-the-counter derivative contract which binds the buyer and the seller of the contract to exchange a series of payments between themselves where one end of the payments is variable following one underlying asset or rate and the other end is either variable or fixed following another different underlying asset or rate. Now, pertaining to swaps, let us understand who is a buyer and a seller. In our example, friends, the swap dealer is the seller and XYZ is the buyer. The buyer, as we said before, the buyer is the long person or the long entity and the seller is the short entity. How do you confirm it? Let's say if interest rates fall, who benefits, friends? The one who is paying the variable payments in this swap. Who is paying the variable payments? The swap dealer is paying the variable payments. So, the swap dealer has a short view of the interest rates. On the other hand, if interest rate rise, who benefits, friends? Obviously, it is the XYZ entity because now the increased payments are being borne by the swap dealer and XYZ only pays the fixed amount. So, XYZ is actually long entity. It is having a view that interest rates will rise and accordingly it is in the bet. Swap dealer is of the opposite view and accordingly it is in the bet. Now, we will come to a few other concepts. First, let us talk about the concept of netting. What does netting means, friends? Let's say in our given swap, we had periodic payments which were equal to the difference of the variable payment and the fixed payment, right? Now, in case of a swap, the rule is that differential payment has to be made by whoever has the higher payment due. So, for example, if in any period, let's say I, t is equal to I, if the variable payment is greater than the fixed payment, then the swap dealer has to pay, right? And in some other case, if the fixed payment happens to be higher than the variable payment for that period, then the company has to pay, XYZ has to pay, right? So at each period, only one of the parties has to pay and the amount is equal to the differential of the two amounts, whichever is higher. So at each point, the person who owes the higher amount can default. You are understanding? So at each period, the person who owes the higher payment amount has the chance to default. The lower payment amount entity does not have any chance to default because the rule is only the differential payment has to be paid. This phenomenon of only paying the differential amount is what we call netting. Then there is another concept called notional principal. Now in our example, neither the company XYZ nor the swap dealer exchange any principal amount between them. But a principal amount was taken into consideration to calculate the fixed or the variable payments. Hence we say that there is a notional principal based on which a swap agreement happens. It is not exchanged between the parties, but it is taken into consideration while considering the variable or the fixed payments. So this is what notional principal is. Now friends, we'll move to the next category of derivatives, which is contingent claims. And the primary kind of contingent claim is an option. We will try to understand what is an option next.